This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set to track declines on Wall Street as trade fears linger, trumping robust US housing and jobs data. The weakness comes as billions of dollars of options contracts are set to expire.
President Trump says he will sign a natural resources deal with Ukraine soon, as EU leaders struggle to formulate a strategy for Kyiv.
And a rare executive shake-up at Apple as the firm works to get its AI efforts back on track after months of delays.
Right, just opened here in Australia, staggered open of course, so hard to get a read on things at the moment, so the market kind of flat right now. It was a very good day for Australian stocks yesterday, up by 1.1%, although we may see a little bit of downside today following US stocks lower. We do have a triple witching contracts expiring, options contracts expiring in the US to the tune of $4.5 trillion. It might mean something, it might mean nothing. We'll just have to wait and see, but it does have a reputation for sometimes generating outsized moves. Nikkei futures currently trading flat ahead of the reopen. It was, of course, a public holiday in Japan yesterday. The yen still looking, relatively speaking, weak compared to what we've just seen. That might be worth watching today. We will have CPI numbers out of Japan a little bit later on. This will be a key piece of the puzzle in determining whether or not we get another move from the BOJ in May. Of course, the central bank remained on hold this week, as did a number of others. We've got the offshore yuan, meanwhile, also holding pretty steady. It's 27.2520 at the moment, Heidi.
Yeah, and that's sort of against the backdrop of a bit of an advance that we see in the greenback as well, that kind of dollar strength and rally, really, as investors seem to be gearing up for that April 2nd tariff a deadline that's coming up upon us. But when it comes to the equity session, you're seeing futures pretty flat there at the moment for the S&P. We had that halt to the Fed-fueled kind of relief rally that we saw in the previous session, that trade fear really returning to the fore despite the latest housing, the jobs data being pretty positive. Morgan Stanley's Michael Wilson, for one, seeing the expectation that there'll be no more new highs for stocks, at least in the first half. He expects equity prices to remain those recent highs, any kind of near-term bounce being a temporary one, which may have been what we've seen this week as well. Just watching oil at the moment as well, we're seeing that advance continue as geopolitical tensions continue. The US ramping up sanctions against Iranian crude by sanctioning a Chinese oil refinery and its CEO for allegedly buying Iranian oil. That's part of that story when it comes to driving up crude prices at the moment. Well, President Trump says he'll soon sign a natural resources deal with Ukraine. The agreement fell apart last month after a tense meeting between Trump and Ukrainian President Vladimir Zelensky. Bloomberg's Michael Heath joins us now. So, Mike, a lot of progress has been made since that now infamous White House meeting.
Yeah, Heidi, and the purpose of that meeting, in fact, was to sign this this natural resources agreement, which sort of would give the US a stake in Ukrainian resources, and some of them being the sort of materials that go into making a lot of high-tech stuff, these sort of precious metals or minerals. So it looks like that is now going to proceed according to what President Trump has said. The question, though, really is how much Ukraine actually has here of that, because a lot of it is a guesstimate. Ukraine obviously has coal, it has some uranium. These things are known, but its holdings of the other things are really it's sort of speculative. So we'll just have to wait and see how much that's actually worth.
In the meantime, we've got the EU really struggling to form what appears to be a coherent policy on how to deal with Ukraine, the ongoing conflict and the potential peace that follows. So where are we at there?
Yeah, it's really, really quite worrying, Paul, because we did see some rapid movement by Europeans, surprisingly rapid movement, given that they usually really struggle to do things quickly. But now we sort of seem to have reverted back to the same old problem. So we had Spain's Prime Minister saying that Europe needs to have a single spokesperson to be able to deal into these talks. That sort of drew the retort from the European foreign policy chief, who sort of asked quite reasonably, what's my job then, if I'm supposed to be that spokesperson? But the Spanish Prime Minister has a point too, because it's going to be, it's president-to-president talks that are going on here, whether it's Russia and the US, whether it's the US and Ukraine, and having someone who's not a head of government might prove problematic. So there's doubts about that. The other issue, of course, is to try and work out financing. They're trying to put together $5 billion euros to help Ukraine buy ammunition. And again, you often see this with Europe, that there's a lot of very fine talk, but then when it comes to the rubber hitting the road, there's doubts start to creep in as well. And it's not just Europe here. We actually have the UK and Canada who are involved in this too. And traditionally, the UK has always stepped up in this area. But then France has expressed doubts as well too. So look, Europe seems to be descending into what's always been its problem, that who do you talk to when you're trying to negotiate with it, and how do you bring 27 countries together to find an agreement that needs to be done quickly?
Quickly, especially given that we're seeing, a rapidly changing approach from the US, right? We're hearing from European officials that even when it comes to Russian sanctions, perhaps unsurprising given the ongoing ceasefire talks, that the US has sort of disengaged on that front.
Yeah, what the Europeans say they're seeing is that these working groups that were set up after Russia's invasion in 2022 to try to implement these sanctions, that either the US officials aren't showing up or it's only low-level people who can't make much of a decision. And that sort of feeds into this whole idea that President Trump is not hugely on board with sanctions, and he would really like to move the US-Russian relationship beyond this whole Ukraine conflict, even though it is such a significant issue. Europe is fairly well wedded to them. And as I've sort of said before, Europe holds the trump card here because Russia does a lot of trade with Europe. Its officials have, and its elite has homes and all sorts of properties in Europe as well. So they have the whip hand here. But the US also, their key point is access to the financial system. So, yeah, they're not unravelling, but it doesn't look like they'll be implemented quite as tightly now.
All right, Bloomberg editor Michael Heath there. Well, President Trump has signed an executive order to largely dismantle the education department as part of efforts to overhaul the U.S. government.
We're going to be returning education very simply back to the states where it belongs, and this is a very popular thing to do, but much more importantly, it's a common sense thing to do, and it's going to work.
Bloomberg's White House correspondent Kayla Gardner joins us now with more. So, Kayla, can you tell us more about the cuts at the agency, which teams are going to be impacted here, and perhaps how durable this could be as well, because there is, of course, the barrier of getting this through Congress and the Senate.
Yeah, well, President Trump signed this executive order today, but it's largely seen as symbolic because the department has already cut nearly half of its staff on its own. That was through both layoffs and voluntary resignation. But as you mentioned, this is something that really falls squarely in the powers of Congress. Lawmakers created the agency, and so they're the only ones who have the power to officially abolish it. But some of the concerns that we're hearing from advocates is in the meantime, the administration could severely gut the agency and really impact some critical services that it offers to K-12 schools and also to student loans. The administration oversees more than $1 trillion for upwards of 40 million Americans. So there's certainly concerns that there could be major disruptions to services for Americans.
Yeah, and on student loans, what are the options in terms of what happens to them?
Well, one thing that President Trump has already tried to do is rein in one federal service student loans program that goes to people like nurses and teachers. He wants to restrict that to organizations that he say allegedly violate laws when it comes to immigration and discrimination. We're still yet to see what organizations that could impact, but that move alone had people concerned that he could potentially roll back a number of other programs and significantly stifle the amount of relief that Americans are currently seeing from the Education Department and have really come to expect for a number of decades now.
There's a lot when you take a look at exactly what's impacted by the different sort of types of programs that could potentially be cut or impacted, and just the breadth of impact, right? Are we expecting this to be quite a disorderly period?
Well, the Education Department is really trying to cool down some of those concerns. They're saying really the critical programs are still going to remain intact. They say they want to return education to the states, but something that their opponents say is states already control sort of the main functions that their local governments have when it comes to education. They control testing standards, they control curriculum, but something that the education secretary floated is potentially, if the government is able to save money, that more money potentially could be flown to the states, and governors are really looking to get some of that funding with no strings attached and hopefully use it in ways that they see fit at the local level.
All right, Bloomberg's White House correspondent, Kayla Gardner there. Thank you. And you can get more on Trump's latest moves and all the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybe Go on their terminals. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you're only getting news on the industries and the assets that you care about. This is Bloomberg.
Take a look at US futures as we set up for that Friday session, and look, it does look like that relief rally, that stock market bounce really waning. There's a number of things at play, including a big options expiry test that will be sort of one of the elements that we're looking out for. But really, the relief over the Fed and some of the narrative from Fed Chair Powell really being replaced again with concerns and anxiety over the trade war, over the incoming implementation of those April 2nd tariffs. But yes, that big test when we see that $4.5 trillion of options contracts expiring in that triple witching, which, as we've seen in the past, often stokes a bit of volatility. Let's bring in for more our executive editor for Asia markets, Paul Dobson. So we've got the Fed sort of beyond us. That relief didn't last for very long.
Not really, Heidi, and I think that the big takeaway from this week, as far as all those central bank meetings is concerned, is we're all flying blind. We don't really know what's going to happen beyond April. You know, the Fed might have tried to give us some reassurances in the way that it sees it, but other central banks all around the world, Bank of England, for example, Bank of Japan too, that we heard from this week, are all sort of talking about, you know, a very unclear outlook. And so the direction for their policy as a result becomes very difficult to predict. And I think that, you know, that's kind of left the market a little bit frozen, like a rabbit in the headlights right at this moment. So we were up and down a little bit in the US session, ended slightly negative, but, you know, nothing particularly moving. And I think that we're in that sort of nervous watch and wait now as we sort of look for more indications about what sort of a framework the US is going to apply for these tariffs that Trump has been talking about that are coming on the 2nd of April, and when they might be introduced and how severe they might be as well.
Yeah, and of course, pretty much every major bank did sit on their hands this week. But the BOJ is going to get an important piece of the puzzle later. CPI numbers for February due in a few minutes' time. How's this going to inform things going forward? Because, as Governor Ueda noted, the broader environment is still pretty uncertain. Yeah,
so the Bank of Japan added that uncertain outlook to its list of things to worry about. But I feel that, you know, they're still very determined to continue to hike interest rates if they can. So they're looking for inflation numbers to remain strong. We've seen very strong wage growth figures as well for Japan. So it's probably just a matter of time before they're confident enough to gradually raise interest rates some more. That's the intention, at least. If it would take quite a down surprise from the CPI figures to knock them off that course, most likely. And so markets will be looking through that number probably. And so long as, you know, there's nothing too adverse from trade figures as far as Japan is concerned, at least, then they're already on that very well telegraphed track.
All right, Executive Editor for Asia Markets, Paul Dobson. Let's get to Nike now. After its latest earnings beat estimates, we can see shares trading a little bit softer after hours. Bloomberg Intelligence says the results demonstrate that a turnaround is beginning to unfold, but the company still has a lot of work to do. Senior retail analyst Poonam Goyal joins us now with more. So fourth quarter guidance was pretty light. Can we have any confidence that Nike can drive this turnaround?
Absolutely. The guidance was light, in fact, and it was expected to be a little lighter than 3Q from the start when they had originally provided guidance. But that said, there's a lot of work for them to do here, but they are taking the right steps to move forward. They are focusing on sports-led product. They are focusing back on building connections with the consumer on the field. They're doing the right things to get back on track, but it will take time. It's not going to happen overnight. And we think it's still several quarters out before you can really start to see inventory getting realigned, which is key here.
Yeah, that inventory reset is key, as you say. It's still elevated. Management trying to reduce discounts across digital, increasing volume to value. How does this potentially play out when it comes to brand equity?
Yeah, so that's a great question. Inventories were down 2% at the end of this fiscal quarter, and sales were down 9%. In retail, you like to see inventories aligned with sales. So there's clearly a lot of work here for management to do. Now, what they're doing is they're liquidating all the classic inventory that isn't working for them. In fact, they expect classic footwear inventory to be down in fiscal 2026 by 10 percentage points. So there will be a drop. But that said, it's going to be taken out of the system through value. So they're going to put the inventory that they don't want in the channels that you would expect to see discounts. And they're going to sell more full price in their digital channels where there will be newer product. So the question on brand equity, we don't think it'll impact brand equity if they do it this way. If we start to see discounts appear more aggressively again in the full price channels and even in the wholesale full price channels, then I think it's a bigger concern, but that's not the plan.
Honam, we've got to talk about tariffs, right? What is the implications of a global trade war, given that I think fiscal 24, we saw China produce, about 18% of Nike footwear?
Yeah, look, tariffs are obviously not a good thing, right? Whether it comes to margin or if it comes to consumer demand. Clearly, as we go through this tariff battle over the course of the year and maybe into next year, we will see consumer demand be impacted. That said, if we go back to where we were, several years ago when President Trump was president, the tariff increase at that point was much more significant than it is today. So we've seen Nike and others diversify out of China to help them alleviate some of this pain. And we'll probably continue to see that and really direct the inventory that's made in China to China and to other regions outside of the US.
Bloomberg Intelligence Senior Retail Analyst Poonam Goyal there. Well, Chinese food delivery platform Meituan is projected to keep up a 4-year streak of at least double-digit percentage growth when it announces December quarter numbers, mainly due to its expansion of its business within China and also abroad. Let's bring our China correspondent in Hong Kong, Min Min Lo, who joins us there. What do we expect? Because expectations are pretty high.
Yes, pretty high because Meituan expected to bring in revenue of about close to 20% growth on year in the last quarter thanks to its overseas expansion. I think anyone living in Hong Kong would notice that Deliveroo, one of the main competitors, have been forced out of the business in Hong Kong because of this competition. So investors are going to be closely watching whether Meituan will be able to keep up with this track record in its overseas push beyond Saudi Arabia and Hong Kong. Of course, domestically, the commerce market there expecting to see margin gains as well on the back of stronger order volumes, lower unit costs and improved delivery efficiency. But Meituan has also been launching quite a number of new initiatives, including the Insta Shopping platform, which is an on-demand retail platform that's been able to attract new users, more repeat purchases, thanks to more sellers, more product offerings, a recent tie-up with Walmart as well. But we still continue to expect losses in 2025 and beyond with these new initiatives, because the company CEO mentioned that they're going to continue focusing on grocery retail, which is one of the new initiatives as well, plus overseas expansion and tech. But still, analysts pretty bullish on the stock because the price target still indicates an average of about a 30% upside on a 12-month basis. Given that this stock has already almost doubled over the past year, up about 90% over the past year, so pretty bullish outlook on Meituan.
Well, let's talk about Pinduoduo as well. Revenue there missing analyst estimates yesterday. How's the market reaction been so far?
Yeah, it's not been great for PDD because the revenue came in at about 24% against analyst estimates of 30%. So falling quite far short there. Net income came in at about 18% gain on year. And you look at the stock moves yesterday in the US session, initially clocking losses, but reversing that and ending the day 4% gains. But then after hours, you see on the screen there, it dropped again because Nomura had came out with this report downgrading the stock from a buy to a neutral with a price target at $130. And that's essentially where the stock is trading right now. So outlook not looking too good. The executives were mentioning a couple of factors. One is the external uncertainties, and domestically it's the intense competition. So of course the US tariffs, the potential revoking of the de minimis rule would remove an essential advantage for Temu, which has been able to so far ship small packages to the US without customs duties. And so far we have seen the company starting to diversify their logistics supply chain, moving items in bulk to the US and paying tariffs for it. But obviously that's going to eat into margins. It's going to put pressure on their discounted prices. Overseas in Europe as well, they're facing an investigation over whether the company is selling illegal products. And then domestically, you look at JD.com, Alibaba, both reporting better than projected earnings. And so last August already, we had that profit warning from PDD that the profits are going to trend down from here. So overall, JP Morgan is saying that there essentially was no major bright spot in the earnings call yesterday. So pretty an opposite story from Meituan, essentially.
All right, Bloomberg's China correspondent Min Lo there. Let's get to some other corporate stories we're tracking. FedEx's shares fell in the US after the firm lowered its full-year guidance for the third consecutive quarter. The company is facing mounting economic issues driven by inflation and demand uncertainty. FedEx is now expecting adjusted earnings to be about $18 per share this fiscal year, and revenue might be slightly down versus last year. Apple is said to be undergoing a rare executive shakeup in a bid to get its artificial intelligence efforts back on track. Sources say Tim Cook has lost confidence in the ability of AI head John Giandria to execute on product development. Vision Pro creator Mike Rockwell will now take over Siri. He's expected to bring his technical expertise to the virtual assistant service, which has struggled with engineering and quality problems. Hanwha Aerospace is planning to raise $2.5 billion in what would be South Korea's biggest share sale in more than 3 years. It will issue almost 6 million shares at $412 apiece. The country's financial regulator says it will review the plan. Soaring demand for defence stocks helped the weapons manufacturer double its market value this year. Bloomberg has learned UBS is considering relocating its headquarters if Switzerland sticks to its demand that the bank hold an extra $25 billion in capital. Sources say executives believe meeting this requirement would make the group uncompetitive to global rivals. A draft proposal is due to go before lawmakers in May, but any changes would likely not be implemented before 2028. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're trading when it comes to currencies at the moment. The yen, as Japan comes back online in terms of that public holiday, we're seeing dollar yen staying pretty close to the center of the Bollinger Band there at the moment. We've seen the yen kind of mostly holding its own despite a session of a return to some dollar strength, some of that risk aversion going into now refocusing on what's going on with trade ahead of that April 2nd deadline. But we are seeing a broad kind of lack of conviction, or perhaps a lack of clear catalyst after a week of some pretty frenetic central bank action. That outperformance when it comes to the yen since the Fed could look a little bit vulnerable depending on what we get in terms of Japan CPI data, should that perhaps surprise to the downside. Dollar China is pretty stable at the moment. Also watching the euro there as well, which is looking perhaps a little bit more neutral. This is Bloomberg.
Breaking news out of Japan, it is CPI numbers for the month of February. A bit of an upside surprise here. The headline number 3.7%. If we take a look at core CPI, excluding fresh food and energy, got a rise that was in line with expectations of 2.6%. Excluding fresh food, though, on year, the 3% rise. The expectation was for a 2.9% increase. So a bit of an upside surprise there for CPI. Not a lot of movement for the yen, still holding pretty steady there at 148.70. And of course, there was no movement either from the Bank of Japan this week, although Bloomberg Intelligence does see a possible rate hike in May, and off the back of some surging wages and food prices as well, one might think that a rate increase from the Bank of Japan in May might becoming more of a possibility there. Take a look at futures there. We're seeing declines accelerating for Nikkei futures that were flat about half an hour ago, now off by about 0.4%. Taking a look at bond space as well. The Japan 10-year holding pretty steady at the moment. Saw a fair bit of movement in US Treasuries, however, on Thursday. The yield on the 5-year briefly broke through 4% for the first time since mid-March. We also saw the 2-year rate sliding to 3.96%. We will have bond trading in the Tokyo session resuming today. Was, of course, closed for a public holiday yesterday. Not a lot of movement in some of the other notes that you see on the screen there. The Aussie 10-year holding pretty steady. This is despite yesterday's somewhat disappointing jobs numbers, which will make for an interesting conversation for the RBA at the end of this month. Heidi.
Well, former US Treasury Secretary Lawrence Summers says US economic policy is moving in the wrong direction. He tells Bloomberg that President Trump's tariffs are making the Fed's job a lot more difficult.
He should be focused on the fact that we had a shock that pushed inflation up and growth down. And that's a bad supply shock. That's a self-inflicted wound. And it tells us that policy is moving in the wrong direction. And it's a shot against the bow of the Trump tariff policies, which clearly have materially changed the picture in a way that the Fed is seeing both as more uncertain and more problematic on both their key objectives.
I was struck by the fact that in the projections, the growth projections were taken down, not just for 25, but 26 and 27 as well. On the inflation side, it was really mainly in 25, and you heard Chair Powell say maybe the effects are transitory, using that word we've heard before.
I would have thought the chairman would retire the word transitory. That is perhaps the most notoriously ill-chosen phrase of his excellent 7.5-year run as Fed chair. And so I was astonished to see him resurrect that concept. He might turn out to be right, particularly if the economy suffers a recession. It's conceivable that the economy won't suffer a recession and he'll turn out to be right. But it's certainly not something that I would want to bank on. There's another point that I think most observers have missed, which is if you look at the dot plot, the median, the person in the middle on interest rates, has not changed. That's what everybody's highlighted. But the average, if you just take an average of everybody's forecast, that's moved up a fair amount in the last few months, reflecting the fact that with these tariffs, with the inflation they're bringing, there's less confidence on the part of the Fed that they're going to be able to cut rates, even as there's a prediction of more cyclical weakness in the economy. So this is clearly a more worrying picture than we had in December, and there's only been one important change, and that's been the change in tariff policy and, more broadly, the political approach to economics.
Former Treasury Secretary Larry Summers there, and Summers is a paid Bloomberg contributor. Take a look at how we're trading. Well, we're just about half an hour into the start of the session here in Sydney on Friday. A broad lack of catalysts, a broad lack of convictions after what's been a pretty busy week of central bank action, but we're not seeing a whole lot of drivers here. We're seeing some downside there when it comes to trading here in Sydney. About 0.1% there. Broadly, we're expecting Asian equities to follow that Wall Street decline there. Futures for Japan and Hong Kong also edging down at this point with, of course, the Japanese inflation data that we got a little bit earlier. Again, doesn't particularly sort of alter the trajectory, but certainly we have seen really that data just trending in the right direction. This market, though, certainly expected to remain volatile. Investors weighing the likelihood now of an escalation in trade tariffs. We've got the April 2nd 2nd deadline from President Trump as well. Even some of the sort of better data when it comes to the strength of the US economy hasn't really dissuaded some of that downside risk there, particularly with that potential for a US recession or stagflationary scenario potentially emerging. Watching tech and Apple suppliers in the Asian session as well, with Bloomberg learning that Apple is undergoing a rare shake-up of its executive ranks. Sources say the changes are aimed at getting the company's AI efforts back on track after months of delays and stumbles. Our tech reporter Annabelle Jewellers joins us now. So the catch-up when it comes to AI has been a bugbear for some time. And what changes are we seeing to try and turn that ship around?
Yeah, it's really quite a significant executive change that's taking place. So John Giannandrea was hired back in 2018. He's actually a sort of an ex-Google star, but he was hired in 2018 to lead up the company's AI efforts. It does seem, and this is according to our sources because it's a Bloomberg scoop, but CEO Tim Cook appears to have lost some confidence in his ability to execute on product development. So now he's actually shifting and bringing in a new executive. This is the creator of the Vision Pro, Mike Rockwell. And so he's really one of the very few executives at Apple over the past few years that's managed to take a product from concept to market. Here you're just taking a look at those three executives, Tim Cook, John Giannandrea, and also Mike Rockwell as well. But essentially, and this is again according to our sources, Mike Rockwell is going to be taking charge of the Siri virtual assistant, and ultimately, given the reporting line at Apple, it means that John Giannandrea will no longer have any oversight of Siri at all. And we're hearing that Apple is going to announce these changes to executives this week.
Belle, why is the need to get the issues with Siri sorted out becoming so urgent?
Well, I think it's really just this broader sort of crossroads that Apple is really facing when it comes to AI. As Haidi was saying, it's really no secret that the company has fallen behind in the AI race, and there's no signals either that it's catching up, because you think about the Apple Intelligence platform, for instance, that was announced with a lot of fanfare, and it's largely been a flop, even though it was supposed to be the main selling point for the iPhone 16. The need to rescue Siri, though, it is becoming sort of, to your point, Paul, increasingly urgent because the company struggled to release new features. They were announced last June, including the ability to tap into a user's data and also to fulfill queries. So despite that technology not being ready, Apple actually used it as a selling point for the technology. So again, by tapping or leaning on Mike Rockwell, who's, as I said, former Vision Pro executive, they're essentially leaning into an executive that's got proven experience. He's demonstrated the ability to ship new products, to run an engineering organization with thousands of people. He's got a knack for solving problems. And so, yeah, I mean, taking it, I guess, in a new direction, but a very important time for Apple, whose shares, of course, like others in big tech in the US, have been under pressure so far this year.
All right, Bloomberg's tech reporter Annabelle Jewellers there. Now, you can watch us live and you can see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions that we talk about, and you can become part of the conversation by sending us instant messages during our shows. Now, this is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg.
Businesses that have some portion of their revenue that comes from government spending feeling some pressure. Companies in the supply chain uncertain about the tariffs and so forth. Capital markets related businesses, obviously financial services, have seen a pullback given the market volatility.
That's Blackstone President and COO John Gray speaking there with Bloomberg's David Weston. Well, our next guest runs the largest public U.S. real estate investment trust, Prologis. They operate about 1.3 billion square feet in 20 countries, including customers with the likes of Amazon.com and FedEx. Joining us now from Tokyo is Chairman and CEO Hamid Moghadam. Hamid, thanks so much for joining us today. In terms of the extensive footprints with your leasing of distribution facilities, I'm just wondering if you've noticed any change in tenant behaviour or demand in this environment of trade uncertainty.
Good morning. Up until about 2-3 weeks ago, all the signs were extremely positive, and there was almost a surge of demand on the back of a pretty slow 2024. In the last 2 to 3 weeks, I sense a change in tone in terms of some decisions being slowed, but the need is actually there. Whether it's translating into actual leasing remains to be seen. We haven't seen any negative data yet, but there's usually a couple of week lag. So I'm looking very carefully at the data that's coming in.
Is it particularly challenging at the moment forecasting demand? Because uncertainty is a word we're hearing a lot at the moment, even from the likes of the Federal Reserve Chair, Jay Powell. I mean, how are you thinking about and positioning ahead of all these tariffs we're expecting on April the 2nd?
So it's interesting. Any kind of disruption, whether it's a pandemic or an earthquake or tariffs now, puts a lot of pressure on the supply chain. And as a result, companies need to carry more inventory in the supply chain to be able to fulfill their needs. So it's a little bit counterintuitive. Tariffs slow down the economy and create more inflation. But actually, in the very short run, it increases demand for logistic facilities. In the long term, of course, demand is tied to economic growth, and if tariffs continue, I would expect long-term demand to soften. But the short-term effect is for sure positive.
Tell us about sort of outside of the US, where are you seeing the growth and investment priorities, particularly in Asia?
Well, I think China is actually bottoming, and there are signs that I wouldn't say it's totally coming back strong, but it is definitely off the bottom, and it feels a little stronger to me. Japan has had very stable demand in the last couple of years. There's been a fair amount of supply that's come on the market in Japan in 23 and 24, so vacancy rates have increased, but demand has been solid, and now construction has slowed. And my expectation is that that continuous demand will absorb the space in the next 24 months.
I find it interesting that you see potentially sort of that recovery in China, right? Because we know that the logistics sector, after a lot of investment in anticipation of a long-term boom in e-commerce demand, that's seen a real slowdown. Does that mean you see that corner really being turned? And how much of an investment are you looking to make in the Chinese market?
Well, it's tough to say for sure whether it's a turnaround or an inflection point or just maybe a dead cat bounce. I'm not quite sure about that. I think we need to wait and see. But I do feel that the sentiment is getting a little bit more positive. And our volume of investment will totally depend on the opportunities as we see them evolve. We don't have a budget for investment. We're always looking around the globe for the best opportunities, and we operate in 20 countries, so we can always allocate capital to places where we see the best opportunities in the long term. The other market that I should have addressed in your prior question is that India is actually pretty strong, and we're building a pretty significant business in India.
Yeah, can you tell us a little bit more about that? What is the demand outlook like for India, and does it provide a more stable trading environment?
Well, for now, for sure, the demand dynamics are very positive. Obviously, you have a large population. That population is gradually getting more affluent, and therefore more consumption. And the key to our business is consumption. The more consumption, the more space we lease. So that has continued in India, probably better than most other places around the world. I would have said until about 2 to 3 weeks ago that the U.S. was the engine, the locomotive that was really pulling the rest of the global economy. But as I said earlier, it remains to be seen whether that will continue or not.
Well, you're joining us from Japan today. I'm just curious what brings you to that country and what opportunities you're looking at there.
Well, we have a very long standing business in Japan, going back in excess of 20 years. It is the second largest market globally for us, and we're both a developer and a long-term owner of real estate in this market through a J-REIT. And as part of my normal duties, I do visit markets to catch up with our team and to get a real firsthand look at what demand is and what the market dynamics are.
What's the opportunity and growth that you potentially are starting to see when it comes to data centers and infrastructure and investment when it comes to AI demand, right? Because at a time when perhaps you are seeing traditional retail and warehousing slow somewhat in the US, are you seeing some of that demand shift to the likes of data center facilities?
Well, there are independent drivers for each one, but you know, at the moment, the demand for data center space is not driven by the economy. It is growing so much faster than the rest of the economy that fluctuations in economic growth are not going to affect data center demand in the short term. If you really believe all the announcements that the large users of data centers have made, the numbers are just staggering. They're in the hundreds of billions of dollars. And of course, the limiter on that is the availability of power to run these data centers. So we're very active in this space. Many of the same land positions that we have for logistics lend themselves to data center development. But the key is procuring the power. And today, we have procured about 3 gigawatts of power, which is very significant. And we're working on opportunities that could be in excess of 20 gigawatts. We're not going to get all of those power applications, but we're working really, really hard to secure power. We're also looking at off-grid solutions, what they call on-premise solutions, to generate power on-site, independent of the grid. And of course, in different countries, that works differently. So there is no general way of talking about that.
Hamid, really great to have you with us today. Hamid Moghadam, the CEO at Prologis, joining us from Tokyo. More ahead on the Asia trade. This is Bloomberg. We do have some breaking news. The Israeli cabinet has voted to fire the head of Shin Bet. That's according to reporting from the Associated Press. This despite thousands of protesters rallying against his removal. This move was flagged some time ago with Netanyahu's proposal to fire the country's domestic intelligence chief, Ronen Bar. Netanyahu, for his decision, citing a lack of confidence in Bar. He's been in the role since 2021, but now being accused by Netanyahu of having a, quote, misunderstanding of the subordination of the service and its head to the political echelon. We've seen widespread criticism and protests. The Attorney General, for example, citing a conflict of interest and accusing Netanyahu of firing Bar to threaten law enforcement agencies. We saw Prime Minister Netanyahu convening his cabinet late on Thursday to approve the ouster of the head of Shin Bet. And it really is just another move that further roils a deeply divided country that is, of course, still at war amidst sort of elevated operations now in Gaza following that brief ceasefire process. We heard on Sunday that Netanyahu was planning to do this. He's had multiple clashes with Ronen Bar since the start of the multi-front conflict back in October 2023. So we continue to kind of watch this, but of course that government vote that we're hearing has come through just days after the ceasefire between Hamas and Israel appears to have broken down, with the commencement of airstrikes across Gaza and a number of fatalities and a number of limited ground troops being sent in there as well. So we'll continue to watch that, watching also, Paul, the financial market aspect as well, because we have seen Israeli assets coming under pressure over the past month with the breaking down of those talks, and now a lot of tension in the Netanyahu government as well.
Well, global investors have largely sat out the rally that's made South Korean stocks Asia's second best performers this year. That might soon change, though. Asia stocks reporter Yukyung Lee joins us now with more. So, Yukyung, global investors have still been selling Korean equities, and that's despite the Kospi's 10% rally. So why is that, and when might they make a comeback?
Sure. Good morning. So yes, the Kospi has been the best performer in Asia outside the high-flying Chinese stocks in Hong Kong. It looks like the foreign investors have been still selling the Korean equities for about 8 months in a row. So that is the longest selling streak that we have seen since 2008. But that might change pretty soon because there are several factors that could be more positive to the South Korean stock market. Number one, we're going to soon see the court's verdict on the impeached president's face as soon as next week, and that could further clear the political uncertainties and bring the political drama to some sort of conclusion, which would be positive for a lot of global investors. So we are expecting some kind of a risk on and some relief rally if the Constitutional Court indeed upholds the impeachment on the President Yoon Suk-yeol, and that could also bring more foreign investors. And another factor that we're watching is the upcoming resumption of short selling on March 31st, and a lot of investors expect this would bring a lot more long-short investors in overseas, and who could place more long-term bets on the South Korean stock market.
So the political element at play, but one of the specific stocks that we're watching when trading gets started, Hanwha Aerospace, was a bit of a surprise share sale announcement.
Indeed, it was. The share has rallied more than 120% so far this year, and it has been the best performer in Asia and in South Korea as well. And this defense stock has made a surprise announcement yesterday in the 2.5 billion share sale, which will be the largest in 3 years. And given the scope and the size of this share sale, it's definitely going to put a big burden on the share price, increase the volatility, at least in the short term. And a lot of investors will likely be unhappy about this, given the discount that the share price is going to be priced at. So a lot of investors are expecting a big share sinking at the opening. So we'll be watching that. Although, given that the Hanwha is aiming to raise capital, the company may have to try to support the share price to succeed the share sale.
All right, Asia Stocks reporter Yu Kyung Lee there. Right, stay with us. We've got market opens in Seoul and Tokyo coming up next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And is it a lack of catalyst, a lack of conviction, or just sort of some exhaustion after what's been a pretty big week for central bank action, or inaction, if you could say? But it feels like these markets are sort of back to the bread and butter of focusing and fretting over what these impending tariffs could bring.
Exactly. I mean, uncertainty continues to be the watchword, doesn't it? But we've also got this shadow of the so-called triple witching hanging over us. $4.5 trillion worth of options expiring in indexes, stocks, ETFs. I mean, sometimes nothing happens, but sometimes we can see some outside moves.
Yes, and perhaps it is just an extra element of sort of volatility and uncertainty at a time when that's already something that investors are contending with in a plentiful way. But let's get you straight to the open in South Korea and Japan. It's a reopen in Japan after the public holiday. We did have some data for the inflation picture. Look, slowing after the resumption of energy subsidies was kind of the major takeaway there. A first slowdown in consumer inflation in Japan for the first time in 4 months in February. Does that change the trajectory for the Bank of Japan? Perhaps not. They're still expected to raise the policy rate again in June or July. A lot of people predicting that pace of one hike roughly every 6 months until the terminal point of the tightening cycle. That sort of outlook remains still very intact there. But the slowdown that we saw in that inflation print largely due to lowered utility costs from those government subsidies that have taken about 0.33 percentage point off the overall inflation gauge. So looking at that, when it comes to Japan, the topics also off by about 0.1%. We have seen the overnight session, just that sort of Fed relief-driven rally failing to bounce again in the Thursday session in the US, despite some pretty encouraging economic data. It does seem like investors are now focused back onto not just trade, but also some of the domestic policies that we're seeing in the US. Of course, a lot to do with sort of the overhaul that we see and the cutting of funding to the education sector in the US as well. Dollar yen is still under that 150 level. We saw a little bit of pressure there after the inflation numbers came out, but not a huge move at this point. Take a look at Korea at the moment, where we are getting the first 20 days exports rising 4.5% year on year in March. Of course, this is closely scrutinised as sort of the canary in the coal mine when it comes to global trade, particularly at a time when we're seeing these escalated trade and tariff tensions, right? A fall in the first 20 days of imports of 1.4%, trade surplus coming in at $1.148 billion US for that period. Daily average exports seeing a rise of 8.2%. Chip exports in particular, we'd like to highlight that, seeing a rise of 11.6%. We saw some weakness when it comes to demand from China. That was a fall of 3.8%, but exports to the US actually rose 2.5%. For these Korean markets, as we see, the cost be looking pretty flat at the moment, with some upside for the KOSDAQ. We are looking at, of course, the political uncertainty once we get sort of potentially an announcement on what happens with the Constitutional Court and that impeachment trial for the president. There is a view that Korean equities could actually see an extension of gains if the court permanently dismisses impeached President Yoon. But that looming decision is one that we're watching very closely out of Seoul, Paul.
Well, we've been trading here in Australia for a little over an hour now. We're seeing some modest gains, building on the better than 1% increase we saw on the ASX yesterday. Materials lagging a little bit. We have seen copper retreating from that $10,000 a tonne level that we saw on Thursday. But I love this story. The best performing stocks on the ASX at the moment, the two supermarket giants, Woolworths and Coles. Now, why? Well, the ACCC, the Competition and Consumer Commission, has just found that they've got so much power, they don't need to compete hard on price, and they've increased their earnings margins in recent years. More significant increase in Woolworths, and Woolworths is the best performing stock on the ASX right now. Yeah, who needs food? We can eat shares. Not a lot of movement on the bond front. If we check in on the oil price, meanwhile, that's a bit higher. The US has been ramping up its sanctions on Iranian crude, and Brent futures are also trading at a discount to Middle Eastern crude, and that's something we don't often see. All right, let's get to Todd Jablonski now, Global Head of Multi-Asset and Quant Strategies at Principal Asset Management. Todd, the watchword at the moment seems to be uncertainty. It's a theme being echoed by everyone all the way up to the Fed Chair, Jerome Powell. Can you tell us how you're trading around this uncertain environment?
Well, indeed, you've seen President Trump's policies really inject the markets with a wave of uncertainty, not seen for many years. And really what we've done is we position our global multi-asset strategies to sort of reset the risk appetite towards neutral, right? Get back to that long-term strategic midpoint. Let your strategic asset allocation work for you, as well as let your issue selection, your manager risk pay off, and let those kinds of risks work in your multi-asset strategy. Now, unfortunately, the market's taken us from below neutral, from neutral to below those levels, just with its market action. So the question becomes, when should investors re-risk? When do we see clarity and enough, of an outlook that investors could invest on to re-rate up to that neutral? And we're just not there yet. In our view, we don't see that kind of opportunity set yet. And not until we're at peak tariff noise do we think getting back to those neutral targets makes sense.
So when you're not ready to re-risk, obviously, so in that context, what's your allocation to havens at the moment? Have you changed your allocation to gold, for example, which is really having a moment in the sun right now?
Well, there are certainly a couple of places you can go, I think, look for stability amid an uncertain outlook. Now, notably, I actually think U.S. stocks look pretty attractive at these valuation levels. In fact, for ex-U.S. investors, when you factor in the expected earnings growth, call it low teens this year, along with dollar appreciation, which I think could certainly achieve high single digits this year for most global investors, that's a pretty good appreciation potential for USD, in USD terms, on an asset class that offers lower standard deviation. I'd also highlight that the 30-year Treasury remains the most consistent risk-off lever that investors have available to themselves. So I encourage you to look at long treasuries as a way to gain safety amid an uncertain environment.
Outside of the US, is there sort of better opportunities to sort of hedge against the tariff risk?
Well, certainly. Well, one, I think gold brought up earlier is an interesting play. While we're deeply underweight commodities in our tactical preferences, we do have a preference for gold, where you've seen surprisingly consistent increases in demand, especially out of Asia, both in the Chinese central bank buying as well as from the collectability in India. You get market forces that suggest India could be a good play over a long period of time. At the same time, oil looks challenged. Other commodity markets look challenged. I would highlight credit, however, as being an area where investors can go even outside of U.S. dollar to gain exposure, whether that's on the high yield side, investment grade side, on the preferred market where you see some euro dollar, euro pay. Those kind of markets, I think, are outside the U.S. are interesting, particularly on EM debt, where I do find local pay currency, IG, can offer investors a bit of an interesting yield premium over what's available in the sovereign markets.
I think when you were last on in January, you were underweight Europe. Has that changed since the broader picture when it comes to defence investing and the sort of broad shifting of geopolitical relationships has really changed since then?
Correct. We've been underweight Europe for a long period of time tactically, and I'm unmoved by the recent market action in terms of our positioning. In terms of wealth creation, in terms of sustainable economic development, believe me, I have seen the estimates for increased spending on defense from Germany. I'm aware of the expectations for Europe across increased defense spending. But sustainability is a question. The effectiveness is a question. You know, hopefully these machines and the spending is never used, which sort of begs the question of how it compounds out across the rest of the economic sectors of Europe. So putting that together, I'm not sold no on the economic turnaround. And in fact, even with expected U.S. slowdown to perhaps 1.7%, maybe 1.5% if things slow from here, that's certainly on pace with what you're getting in Japan, but not likely what you're getting from Europe, which is experiencing its own economic woes.
How about another popular trade? We've seen a big rally in Chinese tech. Are you getting on board with that? Are you chasing that rally?
Tactically, we're not yet on board behind the rally you've seen in Chinese tech. A lot of it feels short-term driven by people expecting policy support to continue, and again, the AI breakout to continue to increase valuations in big tech names outside the U.S. That said, secularly, I do agree that you're going to find tech giants arise in markets outside the U.S. And I think China is a great example of a market where you're going to see those winners just continue to grow and grow. If not the current set of winners, you'll see new ones emerge over time, just like you did in the United States. But that pattern, I think, reemerges. And in the long term, technology giants is a long-term secular force that we think can continue to add value to investor portfolios as it remains easy to access. Now, today, those giants in the U.S. are expensive, even after the pullback. We actually prefer mid-cap stocks over those U.S. mega caps today. But as a secular trend, again, both in the U.S. and in China in particular, we watch that tech sector closely. We maintain secular overweights to that group. Just the current rally, I think, is more, again, speculation around policy.
Todd Jablonski, Global Head of Multi-Asset Principal Asset Management there. Take a look at a couple of the movers that we're watching when it comes to the markets that have just come online. Hanwha Aerospace is one. We're seeing that slump there, actually, of over 13% after offering, looking to raise $2.5 billion in a new share sale. That was something of a surprise when that was announced in the regulatory filing. Some of that will be invested overseas, in overseas ground defence bases, establishing local factories, equity investments for the the defence business cooperation, and some of that across R&D and facilities within South Korea, as well as securing overseas maritime defence and shipbuilding production bases centred in the United States. So a bit of downside reaction there from investors. Also watching Mitsubishi Motors, that's trading higher by 3.5%. They're planning to outsource the production of EVs to Honghai Precision Industry, according to reporting from Kyodo News. Potentially they're interested in that tie-up with Honda Motor and Nissan as well in the same report. Mitsubishi, through a spokesperson, saying the report is not based on a company announcement, but that the automaker will be seeking partnership opportunities with various players for its sustainable growth. But certainly even the rumours of that looking at some upside of about 3.5% there, trading in Mitsubishi Motors today. More ahead on the Asia trade. This is Bloomberg. European leaders are struggling to formulate a strategy on Ukraine and address the risk of being sidelined as President Trump attempts to broker a ceasefire with Russia. The group met on Thursday to discuss defence spending and reaffirm support for Kyiv.
Defence and strengthen our economy are two sides of the same coin, and we need to boost our competitiveness and strengthen our defence hand in hand. Of course, we have a very good exchange with President Zelensky, and we reaffirm our full support to Ukraine.
Bloomberg's Michael Heath joins us now. So there's a real shift in this dynamic.
Yeah, I mean, the Europeans are obviously very keen to or understand that they need to boost their defence spending, their production, their capabilities there, because the US is obviously going to be less influential, perhaps even less reliable than it has been in the past. But what we've seen here is sort of Europe reverting to mean, in the sense that it's they've been really struggling to formulate, to finance support for Ukraine. I mean, the foreign policy chief has been trying to organise a 5 billion euros to finance ammunition for Ukraine, which is obviously urgently needed because Ukraine just doesn't want to lose more ground before any ceasefire or peace talks sort of begin. The other issue is that Ukraine, both Europe and Ukraine, but Europe particularly, has been sidelined from talks so far, as President Trump has just dealt mainly with Russia and then with Ukraine himself. And the reason is that Europe hasn't really got a spokesperson. So Spain's Prime Minister was pushing for someone to be appointed to that role. Obviously, the European foreign policy chief said, well, that's my job, you know, hello, I'm here. But the reality is that because it's head of state talks, I think the Spanish Prime Minister has a very good point that you need to have someone, a point person who is a head of state there to represent Europe.
And is there a little bit of concern among some of these European allies as well that the US is, well, not as committed as they want it to be on sanctions towards Russia?
It's looking that way, Paul. And obviously President Trump has sort of, in his talks, from what we understand, sort of held out the prospect of sanctions relief to Russian President Vladimir Putin if there is a ceasefire and peace eventually. Europe is obviously much more. Europe isn't keen to offer that sort of relief straight away. It wants to see concrete actions from Russia. But what we're seeing is that the working groups between the US and Europe that were established after Russia's invasion of Ukraine to ensure compliance with sanctions, that the US officials either aren't coming there or aren't particularly involved in them, which makes it difficult, to keep an eye on the oil cap that's been imposed and various other measures. And so while while the US has signalled flexibility on sanctions, Europe is much more hardline on that, with good reason. They hold the whip hand here because Russia obviously does a lot of trade and has assets in Europe and would like those lifted very much.
All right, Bloomberg editor Michael Heath there. Well, US Secretary of Energy Chris Wright says Washington could lead the operation of a nuclear plant in Ukraine if a political decision is made. He also tells Bloomberg he supports a rare earths deal with Kyiv after Trump signalled he would sign an agreement soon.
I think a deal could be done quickly. It's a brilliant idea when you think about it. We often use this misnomer term, natural resources. Those resources have been underground for millions of years and they haven't benefited anyone. I call them natural materials. They only become resources when technology, capital, and human activity brings them out of the ground and turns them into resources. But to have the United States as your partner to develop materials that have been sitting there for a long time unused, that's upside to Ukraine, it's upside to the United States, and of course it's a joining together of the nations in an effort on the ground in Ukraine. If I'm Ukraine, I am all in on that deal, and as the American Energy Secretary, I am all in on that deal.
You know, last night we spoke with retired General Wesley Clark, former NATO Supreme Allied Commander. Here's what he had to say about putting U.S. involvement in energy facilities in Ukraine.
Those are old, what we consider obsolescent nuclear plants. We didn't design those plants. They're not our plants. We can't just transplant people over there and say, hey, by the way, this is the GE design, go after it. It isn't. But yes, we could learn to take care of those plants. Zaporizhia, the plant's been partially occupied by the Russians. They've threatened to damage it and destroy it at various times. It wouldn't be such a bad thing if the United States says, well, now you can't touch it because we're in it.
Secretary, your response to that?
Yeah, of course there's complexities in everything when you do business offshore, overseas. Boy, I've done business in countries much more difficult to operate in than Ukraine. But, you know, of course, the general is right. It's a different plant design. But you would bring local experts that know that plant, and you'd bring high-end nuclear experts from the United States, and together, I think wise decisions would be made. If the political decision is made for the U.S. to lead the operation of that plant, so be it. We could do that, I think, with very little problem.
Secretary, have you spoken with any American companies that would be interested in buying a plant like Zaporizhia? And if this happened, whether it was that or another, would your department regulate it?
No dialogues about that yet. No dialogues about that yet. But America's full of expertise in this area. And boy, I, at the Department of Energy, have been overwhelmed with people putting their hand in the air and saying, put me in. How can I help? What can I do? So I think we would see tremendous interest. Something needed to be done. We'd have tons of people wanting to do it.
U.S. Secretary of Energy Chris Wright speaking with Bloomberg there. Some of the other political stories that we're following this hour. President Trump has signed an executive order to largely dismantle the Education Department as part of efforts to overhaul the U.S. government. He's vowed to preserve programs such as funding for children with disabilities and Pell Grants. The order follows an effort to slash the department's workforce by nearly half. The plan faces legal and logistical hurdles, including potential clashes with labor unions and lawmakers.
We're going to be returning education very simply back to the states where it belongs, and this is a very popular thing to do, but much more importantly, it's a common sense thing to do, and it's going to work.
A Maryland federal judge has temporarily blocked Elon Musk's government efficiency team from accessing the personal information of potentially hundreds of millions of Americans who receive retirement payments and other benefits from the Social Security Administration. Musk has called the Social Security program a, quote, Ponzi scheme. The agency paid out more than $1.5 trillion in benefits last year. And Elon Musk is suing the Indian government over content regulation and censorship of X. The social media platform has accused New Delhi of issuing arbitrary and erratic takedown notices. The move coincides with Musk's efforts to launch Tesla and the Starlink satellite internet service in the country, both of which are awaiting regulatory clearances. More to come here on the Asia Trade. This is Bloomberg.
Bloomberg has learned Apple is undergoing a rare shakeup of its executive ranks. Sources say the changes are aimed at getting the company's AI efforts back on track after months of delays and stumbles. Bloomberg Intelligence senior analyst for technology Mandeep Singh joins us now from New York. Mandeep, thanks so much for joining us. Can you tell us a little bit more about the problems with AI at Apple, particularly Siri, and how is this management shakeup intended to fix it?
Yeah, look, they announced Apple Intelligence last year, and certain features were promised in terms of, personalized agents and just, use of LLMs within the Apple ecosystem. And it looks like when you measure, Siri in the latest version of the iOS, the features are still trailing, the likes of what you can get on the Samsung phone with Google Gemini and other LLMs like Perplexity. So when you compare Apple to the other Gen AI applications that are out there, clearly the native efforts are lacking. I mean, you're still accessing, ChatGPT through the Apple ecosystem and other LLMs, but it's all app-based. So it's really the on-device AI. That's where the promise was, that Apple can leverage Siri and, the fact that it owns the operating system. And I think that's where the shakeup needs to happen to really catch up with the other companies that are out there.
We understand that this management shakeup was sort of in the works before, perhaps in the announcements when it comes to Siri. But I do wonder, are you sort of optimistic that this is going to make the difference given the prolonged lag that we've seen for AI at Apple?
I mean, look, when it comes to, hardware, Apple still has the best hardware. Compare them to any other smartphone vendor or, even on the tablet side or PC side. Clearly, the vertical integration when it comes to, having the chip, the operating system, and hardware has worked for Apple in terms of the customer base they have. And to my mind, this is a software problem. Look, there are 4 or 5 LLM companies that are out there, and LLM functionality will get commoditized over time. And because Apple owns the ecosystem, it's just a matter of them integrating, the best LLMs with the best features on their phone. And like I said, you already can access all those features through apps. It's just the native AI functionality is missing, and that's where I think they need to fix things, and I'm sure Apple will catch up.
Yeah, well, on to that point, I mean, Apple's lagging on AI, but they've lagged on all sorts of products over the years and ended up being industry leaders and securing large segments of the market. Could the same potentially happen here?
Look, I mean, look at the number of innovations that NVIDIA has shown, when it comes to GPUs and how AI needs specific type of accelerator hardware. Apple owns its hardware chips. I mean, imagine the kind of innovations they have been doing in terms of, optimizing the chip for their smartphone. And to my mind, they need to really focus on integrating AI at the chip level, which they have been doing. And now it's, optimizing the software, making sure they have the same LLM capabilities that a Perplexity is offering, for example, or OpenAI or Claude. And maybe an acquisition could be on the table in terms of acquiring some of these features, because clearly they've been missing out, and acquisitions could be one way to fill that gap.
Bloomberg Intelligence Technology Senior Analyst Mandeep Singh there. More ahead on the Asia trade. This is Bloomberg.
Let's take a look at how Asia markets are tracking at the moment. We've got gains for the Nikkei, up about 1/5% right now. A little bit of weakness for the Kospi there. The ASX, after a positive start, now just starting to look a little bit flat. The story in Japan, however, is consumer prices, which we did see, well, inflation slowing in February for the first time in 4 months. CPI, though, excluding fresh food, did still rise 3% from a year ago. That was more than expected. Bloomberg senior editor Brian Fowler joins us now. So inflation's slowing, but these numbers were still a beat. What are the implications here for the BOJ?
Yeah, so Paul, the bottom line is that definitely these figures will keep the BOJ on track to raise rates in the coming months. And of course, the big question is whether it comes on May 1st or whether the authorities decide to wait until June or July. As you said, the slowdown was not quite as steep as we thought it would be. And in fact, the core rate that excludes both energy and fresh foods actually picked up. So a lot of the effect for the big number, the headline number, we saw the subsidies for electricity and gas take about 1/3 of a point off that figure. and we also saw fresh food come down a little bit. But the underlying price trends remain pretty strong, and we saw that in the service prices. So we'll have to see what happens. But of course, the other big factor is wages, and we're going to get a second update on the Rengo tally later today.
And it's interesting because even though we've seen some pretty significant gains when it comes to wage growth, the problem is it's still not sort of keeping up with the changes in inflation, right? Is that household confidence and spending capacity kind of factor one that could hold the Bank of Japan back?
It's possible, Heidi. We did see consumer confidence fall a little bit in the most recent report. Governor Ueda has said, though, that he thinks that real wages will actually start to turn positive in the months ahead. That remains to be seen. But the Rengo current price tally for wage gains is well over 5% for this year. And, of course, that exceeds the inflation pace. So it is quite possible that we'll see real wages turn positive. Another question is how far and how broadly the wage increases go throughout the economy. Rengo, of course, represents mostly big companies, and we need to see the smaller companies, the suppliers, also have the capacity to raise wages for that full effect to come into play.
The BOJ doesn't seem super concerned about the external environment right now. Is that likely to change depending on what happens with the impact of tariffs?
Yeah, that's another big question mark. Ueda talked about this on Wednesday after the decision, and he said that the uncertainties are on the increase, so he's definitely worried about it. He said we'll have probably more clarity on how tariffs might affect the economy going forward in early April. He didn't say specifically, but of course we know he was referring to the reciprocal tariffs and other measures that are expected to be detailed on April 2nd. So I think he's worried about it, but he's not quite ready to say that it's going to convince the BOJ to possibly pause for a longer than expected period.
Bloomberg senior editor Brian Fowler there in Tokyo. Well, Chinese food delivery platform Meituan is projected to keep up a 4-year streak of at least double-digit percentage growth when it announces its December quarter numbers, mainly due to the expansion of its business both within China and abroad. Let's bring our China correspondent Min Lo. So we're seeing this optimism despite, of course, what is continuing to be a pretty challenging domestic macroeconomic environment.
Definitely, and Meituan is definitely one stock to watch because some investors think that it potentially has the biggest return potential this year, given that the stock so far this year has been lagging behind the Hang Seng Tech. It's up 11% compared to the Hang Seng Tech, up about 30%. But you look at its revenue outlook, actually pretty upbeat. Fourth quarter revenue expected to have climbed by close to 20% on the back of this strong overseas expansion. It's managed to kick out Deliveroo in Hong Kong. Investors will be looking out for how Meituan plans to keep up with its overseas push beyond Saudi Arabia and Hong Kong. And domestically, you mentioned that broad weakness in the consumption sentiment, but actually Meituan has been able to see margin gains on the back of stronger demand for orders and lower unit costs, better efficiency in its delivery system. It's also been launching a few new initiatives, including pushing into grocery retail and a new Insta shopping platform, which is an on-demand retail platform. And that's where it has managed to also attract new users, a higher frequency of purchases after it managed to expand product offerings, bring in new sellers, partnership with Walmart as well. We expect to still see losses in some of these new initiatives in 2025 and potentially beyond, but the CEO has said they will continue to double down on this overseas expansion and with the grocery retail segment. But still, analysts pricing in an average price target of about 30% upside to the stock this year.
Let's talk about Pinduoduo as well. Revenue there missing analyst estimates yesterday. So how's the market reaction been so far?
Yeah, it's a bit of a volatile day yesterday for Pinduoduo. It was trading to the downside at the open of the U.S. session, but ended the day in the positive, up about 4% after a broad market recovery. But then after hours, we saw it give up all the gains, now in the negative territory after hours. That's after Nomura had downgraded the stock from a buy to a neutral and cutting the price target to 130, which is essentially where the stock is trading at right now. And that's after that earnings miss yesterday. Revenue coming in at 24%, but analyst estimates had been at 30%. Net income came in at an 18% gain on year. And a couple of headwinds. The executives talked about the external global uncertainties, internal competition, and actually since last August, we already had that profit warning from Pinduoduo talking about intense competition. You look at Alibaba and JD, they have managed to report better than projected earnings on the back of government subsidies to boost consumption. So that is also a hit to PDD. Plus, of course, the tariffs from U.S., the potential revoking of the de minimis rule, PDD taking measures to start to prepare for that, starting to ship items in bulk to the U.S. to store in overseas warehouses and having to pay tariffs for that. All of that eating into margins, and so not boding well for its future earnings. And actually, JP Morgan is saying that there really isn't any major bright spot at all from the earnings call yesterday.
All right, Bloomberg's China correspondent there, Min Lo. Let's take a look at how US futures are tracking, modestly to the upside at the moment. We did see some modest losses on US markets in the Thursday session. We could see a little bit of volatility going forward. It's the so-called triple witching, a lot of options tied to stocks, indexes and ETFs expiring. So we could see some outsized moves here, or maybe not. But at the moment, futures looking reasonably quiet, positioned slightly to the upside. Now, you can catch our exclusive conversation with Atlanta Fed President Raphael Bostic on the central bank's outlook, inflation concerns, the impact of tariffs as well. That's coming up 1:30 p.m. in New York on Monday. That's 1:30 a.m. Hong Kong on Tuesday. We have more ahead on the Asia trade. This is Bloomberg. BP is shifting its strategy back to fossil fuels after a failed attempt to rebrand itself away from petroleum. Bloomberg Originals takes a look at the reasons which has forced the company to re-embrace oil, especially the pressure from an American activist investor.
The cost of living crisis, scorching heat wave, natural disasters. How much worse could it get?
It's really no surprise the term Schadenfreude gets thrown around when an oil company is seen to be suffering.
They want their profits at all costs, at the expense of our people and our lives.
And right now, BP is really suffering.
They lost a lot of money, and they lost the faith of a lot of investors.
And 15 years ago, it lost a catastrophic amount of oil. And a litany of boardroom disasters since then haven't made things any easier. And it's attracted something unprecedented.
Bloomberg has learned that activist investor Elliott Management has built a significant stake in British oil major BP.
Even a couple of decades ago, the idea of an American investor taking a stake and forcing the company to rehaul its entire strategy would be pretty much unthinkable.
Yet that's where BP finds itself, amid a fractious realm of competitive disadvantages and a geopolitical outlook fraught with uncertainty.
You can watch the full version of that documentary by Bloomberg Originals team on the terminal, on YouTube and over at Bloomberg.com. Take a look at what we're watching when it comes to trading in commodities and energy assets at this point. It has been that bump up when it comes to crude in particular, just extending that gain as the US sanctions on a China refinery for Iranian oil trade is really seen as a potential risking escalation of physical oil flows in the region. Even though the physical implications of that action seem sort of minimal at this point, we're still seeing that geopolitical risk sending crude on track to its biggest one-week gain since mid-January, despite still on the demand side, I should say, some pretty bearish headwinds there from obviously impending tariffs, the impact on global trade, the potential for OPEC plus supply increases next month as well. Well, President Trump says he will soon sign a natural resources deal with Ukraine that would give the US partial control over revenue from future resource extraction. But Trump's focus on Ukraine's commodities is raising questions about what the nation has to offer. Let's bring in Anna Ohanyan, who's a professor of political science and international relations at Stonehill College. Anna, really great to have you with us. And I suppose if you sort of pull back the lens a bit in terms of the broader complete shift in a diplomatic approach that we've seen from the Trump administration the second time around, do you think there's folly there? Because clearly President Trump and his colleagues think that there is a grand bargain to be struck with Russia. Does history tell us otherwise?
In general, I think within American foreign policy, there always has been a temptation, a drive to think that a geopolitical bargain with the Kremlin will trickle down into peace and prosperity in Russia's peripheries, new imperial peripheries. This was tried in 1990s. There are all kinds of reasons to do that. But in this particular case, again, President Trump's approach to bargaining with Moscow seems like seems disruptive, kind of reflecting Trump's signature approach to international relations. But I would say that this is more of a déjà vu in terms of hoping that finding a bargain will help to solve conflicts, and in Ukraine in particular. But I would say that that is quite dangerous. In trying to separate relationship with the Kremlin, with President Putin, from the negotiations in Ukraine, simply because President Putin at this point is trying to resuscitate, to carve itself out from the hole that he has dug himself in, while continuing to press and pressure on Ukraine, still maintaining rather maximalist strategies. I'm skeptical that President Trump might be able to be effective in negotiations with President Putin, considering that his goals remain quite maximalist. And the negotiation table, the issues, the agendas, the process, the way President Trump is arranging is not allowing Washington to exert leverage, to play its strong hand effectively. I would say that Washington is playing its very strong hand quite weakly.
That's quite interesting because, as you say, the underlying sort of strategy seems to be the belief that the Trump administration holds that diplomacy should be inherently beneficial. And by that, of course, we mean economically beneficial. What can they really get out of Ukraine, given that we know that when it comes to rare earth reserves, for example, it has very little to offer? And does that sort of trickle through to what it expects to get also from Russia?
President Trump's approach to international relations remains very transactional, very focused on a single deal. But of course, structuring deals in international negotiation in a global context of global geopolitics is completely different. Even if President Trump succeeds to get preferential deals, like makes a deal on rare earth metals or whatever, I think the huge damage in terms of the economic impact from the way these negotiations will be carried out is not going to be beneficial for the United States or for global companies in general. If negotiations proceed the way they are, United States will end up legitimizing conquest, a territorial grab, which will weaken stability, transparency, norms against conquest, all of these that have made global capitalism workable, sustainable, and beneficial to many, many countries around the world. So I would say that this is the stakes, the economic stakes for President Trump, for United States, for Ukraine, are much more than the resources that Trump is thinking that he will get. And Russia, of course, is playing on this as well, offering Russia's vast resources to President Trump, which in his thinking, he will definitely present this as a diplomatic success. But let's think that Russia has already done that. Russia was open to global businesses, to American businesses, and yet Russia sabotaged its position in the global economy by attacking the international system, which makes this global stability, global economic stability possible.
Anna, I'm sure you've heard the phrase reverse Nixon. It's been floating around a little bit recently, and this would refer to perhaps an attempt by President Trump to lure Russia away from the orbit of China. Does that seem like a realistic strategic goal to you?
I remain skeptical simply because that Russia-China coordination has been deepening quite significantly, and creating a wedge between Russia and China, I don't think it's realistic, simply because the economic investments in connecting energy transition from Russia to China already have been deepening. There are deep regime coordination that is going on. I wouldn't call this deep strategic partnership, but their interest in supporting or in creating authoritarian coordination between Moscow and Beijing. So this calculation that by engaging with Russia, President Trump would be able to deal with China more effectively, I'm skeptical. I think the United States would have been better off in figuring out how to engage with China and actually do the opposite and using China in order to reduce bargaining power for President Putin. And I think one big worry that I have, the way these negotiations are unfolding, is that Washington deals with Kremlin as a state, but Kremlin, Moscow, very much approaches its war of conquest in Ukraine in neo-imperial terms, meaning that depending how processes unfold in Ukraine, Washington, intentionally or not, will resuscitate Russia's neo-imperial organization, meaning that a success in the battlefield in Ukraine, for Russia will be translated into greater leverage, greater influence in the South Caucasus, in the Central Asia. In Central Asia and the Caucasus are critical regions for the United States to have influence, to have some influence over the Eurasian continent, especially as it tries to manage its relations with China. So not dealing with Russia's new imperial organization all the way from Ukraine to South Caucasus and Central Asia, the United States might end up making it difficult for itself in managing its rivalry with China.
You mentioned a little bit earlier Putin's maximalist approach to peace negotiations. I mean, one of his lines is that Russia is unwilling to accept European peacekeepers in Ukraine at the conclusion of the war. I mean, how credible would a ceasefire be without this?
That's a very good question. I think the pattern of negotiation by the Kremlin is setting new standards. By rejecting possible European peacekeepers, Russia is definitely signaling similar steps. For example, right now, Armenia and Azerbaijan negotiated an agreement, peace agreement, and there are European civilian monitors on the border on the Armenian side, and yet President Aliyev refuses to sign it, continues to manipulate media, and basically tries to get the European civilian monitors out of the South Caucasus. So this is very similar to what Putin is doing in Ukraine. In terms of getting to a sustainable ceasefire, I do not think that at this point Putin is negotiating, at least negotiating on good faith. In general, there are some quantitative studies that wartime diplomacy is not always effective, is not always carried out in order to achieve specific goals. But on the contrary, one recent study points out that from 1823 to 2003, only 25% of 189 cases of wartime negotiations succeeded in producing a negotiated settlement. This is a study by Eric Min, meaning that belligerents always do engage in negotiations, but getting to an outcome is not always the objective. Negotiations are used as a strategy of hybrid warfare, meaning to achieve objectives on the battlefield, which the belligerent would not have been able to achieve through warfare, so it can basically get what it wants at the negotiation table. So I think this is a case of a wartime negotiation, and it needs to be approached with great caution. I'm not convinced that President Putin is negotiating at this time.
All right. Anna Ohanyan, Professor of Political Science at Stonehill College. Thanks so much for joining us with your insights today. Now, you can watch us live and you can see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, and you can become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg.
Take a look at what we're watching. Hanwha Aerospace is now extending that slump now to 15.5% after that surprise share sale announcement. We have seen share price targets being cut by Nomura and some other brokerages after the defence firm announced that surprise $2.5 billion rights offering. Analysts saying that the capital raise, unexpected as it is, coming after the stock rallied more than 120% this year, could be controversial and increase that share price volatility in the near term. And we are seeing and we are seeing that volatility play out today. We're also seeing some regulatory scrutiny there at the moment as well, with the Financial Supervisory Service in South Korea to review that plan to issue new shares, considering the large scale of that capital increase, according to what we've heard from the watchdog there. So perhaps that is a factor that's playing out as well. Mitsubishi Motors, though, extending gains to just shy of 5%. They are, according to Kyodo News, planning to outsource production of EVs to Honghai Precision Industry, as well as a tie-up with Honda and Nissan. The company not saying that this has come from them, but broadly saying that they are looking at partnership opportunities. Paul.
Let's take a look at our quantum computing stocks tracking. This is kind of an interesting story here because Jensen Huang, the NVIDIA CEO, said he didn't realize that there were publicly traded quantum computing companies when he made comments back in January that caused those stocks to crash. He said quantum-related computing stocks are very useful. Quantum computers, probably decades away. Well, they always had the potential to exist, didn't they? Well, that is it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next.